Hey, welcome back. Before we start today's lesson, let's take 30 seconds to recap. Last lesson covered three key things. First, VOO and SCHD are two of America's most popular ETFs, but with completely different philosophies. VOO chases total return. SCHD chases cash flow. Second, on $100,000 over 20 years, VOO grows to $960,000. SCHD grows to $560,000. A $400,000 gap. Third, neither one is universally better. Your life stage decides the right mix. Okay, so we've covered growth versus income. But here's the next question. Within the growth side, there are several broad market ETFs to choose from. What are the three biggest, and how do you actually pick? The answer is VTI, VOO, and QQQ. Welcome to Lesson 7, US ETF Basics. Today I'll walk you through these three. They are the largest, cheapest, and most popular US ETFs for beginners. By the end of today, you'll know what each one actually buys, where they differ, and which one you should start with. Before I introduce these three, let me answer a more basic question first. Why should anyone, especially outside the US, buy US ETFs? 3 reasons. Reason 1, scale. The total market cap of all stock markets globally is about $110 trillion. The US alone makes up 60%. Most other developed markets are tiny by comparison. If you only buy your home market, you're skipping the biggest part of the world's economy. Reason 2, you already use American products every day. Your iPhone is Apple. The ChatGPT you use runs on Microsoft. Your YouTube is Google. Most chips are designed by NVIDIA. These companies are all listed in the US. You contribute to their revenue every day, but you don't own a slice of their dividends. Doesn't that feel like a missed opportunity? Reason 3, ridiculously cheap fees. VOO and VTI both charge just 0.03%. These are among the cheapest funds in the world. Many local market ETFs charge 0.3 to 0.5%. 10 times more expensive. That's why even if you live outside the US, you should know these ETFs. The first one. VTI. VTI's full name is Vanguard Total Stock Market ETF. One fund, and it buys nearly every public company in the US. Large cap, mid cap, small cap, all included. The actual numbers. First, holdings, nearly 4,000 companies. Second, expense ratio just 0.03%. That means on $100,000, you pay just $30 a year. Third, the past 10 years annualized about 12%. Fourth, dividend yield around 1.4%. Want maximum diversification? Want to buy the entire US economy in one click? VTI alone is enough. In one sentence, VTI is the most diversified option. Best for people who don't want to overthink it and trust the entire US economy. The second one. VOO. VOO is Vanguard's S&P 500 ETF. It tracks the 500 largest US companies. Compared to VTI, VOO drops the small and mid caps and keeps just the top 500. Apple, Microsoft, NVIDIA, Google, Amazon, Meta, Berkshire Hathaway, Tesla. These are all in there. The top 10 holdings make up about 30% of the fund. The numbers. First, exactly 500 companies. Second, expense ratio also 0.03%. Third, the past 10 years annualized around 12.5%, slightly higher than VTI. Fourth, yield 1.3%. If you've heard of Warren Buffett, you've definitely heard him say this. When I die, 90% of my estate goes into an S&P 500 index fund. What Buffett recommends is exactly the kind of ETF VOO is. In one sentence, VOO is the safest pick. The choice that beginners are least likely to regret. The third one. QQQ. Unlike the first two, QQQ isn't from Vanguard. It's issued by Invesco. It tracks an index called the NASDAQ 100. What's the NASDAQ 100? Simply put, it's the 100 largest non-financial companies on the NASDAQ exchange. Notice that keyword, non-financial. Banks, insurers, credit card companies. All excluded. So what's left? Almost all tech. Apple, Microsoft, NVIDIA, Google, Meta, Amazon, Tesla, Netflix. These 8 companies alone make up nearly half the fund's weight. The numbers look especially shiny. First, only 100 holdings. Second, expense ratio 0.2%. almost 7 times more expensive than the first two. Third, past 10 years annualized about 17%. Fourth, yield only 0.6% because tech companies don't pay much. But there's one thing about QQQ you have to know. High volatility. In 2022, the inflation and rate hike year, QQQ dropped 33% for the year. That means $100,000 became $67,000. The same year, VOO dropped 18%. VTI dropped 19%. QQQ's drawdown was almost double the other two. In one sentence, QQQ is the most aggressive pick. High return, but you need a strong stomach. Now let's put all three on the same table. Holdings count, VTI has nearly 4,000, VOO has 500, QQQ has 100. Expense ratio, VTI and VOO both 0.03%, QQQ 0.2%. Past 10 years annualized, VTI 12%, VOO 12.5%, QQQ 17%. 2022 drawdown, VTI down 19, VOO down 18, QQQ down 33. After looking at this table, you might think, obviously, buy QQQ, the highest return. Hold on. Let me show you the actual numbers. Suppose you invest $100,000 today and let it sit for 30 years. How much does it grow to? VTI at 12% grows to about 3 million. VOO at 12.5% grows to about 3.4 million. QQQ at 17% grows to about 11 million. Over $11 million. QQQ seems to win by a lot. But this calculation has a huge blind spot. It assumes QQQ grows exactly 17% every single year for 30 years. The real world doesn't work like that. In reality, QQQ swings. Sometimes huge gains, sometimes huge crashes. And human nature's biggest weakness is selling at the bottom. So my advice for beginners. Start with VTI or VOO. Once your stomach is strong, then add QQQ to the mix. So how do you actually buy these? You have two main options. Option 1, a US-based brokerage. Charles Schwab, Fidelity, Vanguard itself, Robinhood. Zero commission on US ETFs, easy to sign up if you live in the US. Option 2, an international brokerage. Interactive brokers, eToro, or platforms specific to your country. Slightly more setup if you live outside the US, but commission-free trading on US ETFs. My recommendation. If you live in the US, just open a Schwab or Fidelity account. If you're outside the US, Interactive Brokers handles 150 markets and is the cleanest international option. Now, 3 mistakes beginners make. Mistake 1, seeing QQQ's high return and going all in. You'll panic sell at the first big drop. Always scale in over time. Always keep some cash on hand. Mistake 2, forgetting currency risk. If you're outside the US, the dollar moves. Over 10 years, the dollar can rise or fall 20% against your home currency. The gains you make in US stocks may shrink or grow by 20% when you bring them home. Buying US ETFs means buying both US companies and the US dollar. Don't forget that. Mistake 3, staying up to watch the market. The US market trades 9:30 a.m. to 4 p.m. Eastern Time. For many of you, that's the middle of the night. You'll lose sleep and make terrible decisions. With US ETFs, hold long-term, dollar cost average, don't watch the screen. Okay, that's a wrap on Lesson 7, US ETF Basics. Today you learned 6 key things. First, the US is 60% of global stock market cap. If you only buy your home market, you're skipping the biggest part of the world. Second, VTI covers nearly 4,000 US companies. The most diversified option. Third, VOO buys just the top 500. Buffett's recommended safest pick. Fourth, QQQ bets on 100 tech-heavy companies. Highest return, biggest swings. Fifth, beginners start with VTI or VOO. Add QQQ later when your stomach is stronger. Sixth, US-based investors use Schwab or Fidelity. International investors use Interactive Brokers. This week's homework. 3 things. First, open your brokerage app and search VTI, VOO, and QQQ. See the current price per share. Second, pick one of the 3 to be your core holding, and honestly write down why you chose it. Third, if you live outside the US, look at the 5-year chart of your local currency against the US dollar. See how much it swung. Next lesson, asset allocation. Why can't you just buy stocks? The golden ratio of stocks to bonds. We'll cover why every legendary investor holds both stocks and bonds, what mix fits your age, and the simplest rule of all. 100 minus your age. If today's lesson helped, please subscribe and hit the bell. See you next week.